Question 57. So we are now only left with two questions, 57 and 58. 57 discusses about risk management and back. So these two are the main theme of this question. As you can see, when you skim through that, there are three directors' proposal are there: first, second, and third. You are given the extracts of financial position and other financial information required. It is very important that you will not be able to read first. You will be reading your requirements, but before going to requirements, you can just skim through that, the subheadings and all you can read. Through that, you will have an understanding whether it is a exchange risk management question, interest rate risk management question, reconstructions, acquisition and merger, or investment appraisal question. So coming to requirement A. Explain how business risk and financial risk are related and how risk mitigation and risk diversification can form a part of a company's risk management strategy. This is a theory question. This is not your exchange rate risk management, even though the risk management comes there. So the key word here is business risk, financial risk. You have to say how they are related. For that, you are getting separate marks. Let's say 3 marks for that and the 3 marks for risk mitigation and risk diversification. Okay, know that so the starting point for this type of question is you have to know what each word means, each term means. You need to be able to describe them: business risk, financial risk, risk mitigation, risk diversification. Okay, coming to part B. So part A and part C are not in the report, they are outside the report. Okay, so coming to part B. Prepare a report for the board of directors of the Morada company. So these are the three things, and it have to follow, your report has to follow this order only when you're writing and also when you're doing calculations. First one estimates their cost of equity and cost of capital. So you have to estimate cost of equity and cost of capital based on the market value of equity and debt. Market value of equity and debt, you have to find that also, because based on that only you can find your cost of equity and capital before any changes and then after implementing the proposals. So you have seen the three director, they have put some proposal. Okay, so before changes and after implementing the proposals put forward by first and second directors only, first and second directors, not the third director. Coming to the second, this should be pretty easy for you, but in fact this is one of the hardest requirement. The requirement for the 17 marks, the first one in part B is the hardest one to do. We'll see why. That's what the examiner's report says. Coming to the second one, estimate the impact of the first and the second director's proposal on the Morada company's forecast after tax earnings and focus financial position for the coming year. Now you have to show an impact. Impact means you have to have before the current, then after the first and the second director's proposal. Impact means you have to show them before and after what is the impact of the first and the second director's proposal only. Forget about the third director. If you're thinking that you will go and put the third director's impact also, you're not getting any mark. Don't do what is not asked from you. Only first and second director. On after tax earnings, for this separate marks, and for the focus financial position and other marks are separated like that for the first and the second. Okay, coming to the last one of part B, discusses the impact on the company of the changes proposed by the first and the second director. Now you have to discuss the impact. There in second part, for 7 marks you estimated, that means you just did calculations. Third, you have to discuss now. Whatever calculations you have done here needs to be described in words here. Okay, even though the question looks similar, but this is estimate, this is discuss, these are the keywords. Okay, please see, estimate and discuss are not the same thing. Estimate means you have to calculate, discuss means you have to write. The same only impact. Okay, of the first and the second director, it's not enough. This thing does not stop there. You have to recommend, and recommend whether or not either proposal should be accepted. You have to recommend whether or not it will be accepted on either proposal. Okay, maybe both will not be accepted, maybe both will be can be accepted, or maybe one of it have to be accepted based on some grounds. You have to discuss it. So the discussion should include an explanation of any assumptions made in the estimates in here. First two part, you see it's linked. Report will always be linked. Whenever there are three, four, five separate requirements in under a report, it is always linked, and you have to follow that order. Very important. But coming to part C and A, they are separate standalone questions that can be done in any order. But when you're working for B, you have to work from first, second, and third. An assumption always a priority in a 50 marks question will be asked, no matter what the question is. Coming to section C, discuss the possible reasons for the third party. So you see the third director's proposal is not there in the report. Okay, it is as a separate as part C. So discuss the possible reasons for the third party's proposal that a risk management system should, so risk management, they are saying they should consider each risk before taking appropriate action. You have to discuss. Discuss means you have to write. 7 marks, that means 7 points you have to write. Or you can write 3 to 4 points if 1 mark is worth 2 marks. So now let us read the information and time yourself how long you are taking to read the requirements and understand. Take time how long you are taking to read the whole case study and then allocate the time for writing. Okay, so coming to Morada. First paragraph always throughout the case study you have to read. It is the background information. It is the soul of the case study. Everything is there in the first paragraph. What is the business is at, what line the business is in. Okay. Who are the stakeholders, important stakeholders, the key stakeholders. What are their views, strategic decisions and actions. Everything usually is in the first paragraph. Sometimes it is in the second paragraph also. Okay, so let's read. Morada is involved in offering bespoke travel services and maintenance services. There are two services they are offering. It is bespoke. That means customized. One is travel, the other one is maintenance. In addition to owning a few hotels, it has built strong relationships with companies in the hospitality industry all over the world. It is a good reputation of offering. It has a good, these are the keywords. Offering unique, high quality holiday packages at a reasonable cost for its client. So this is their USP. The strong relationships have also, and also they have a strong relationships within the hospitality company. So the strong relationships have also enabled it to offer repair and maintenance services to a number of hotel chains and cruise ship companies. Because of that relationship, they are now able to offer maintenance services. Coming to the second, following a discussion at a meeting of the BOD about the future strategic direction which the company should follow, three directors continue to discuss one particular issue or dinner. In the meeting, the BOD has expressed concern that Morada was exposed to excessive risk and therefore cost of capital was too high. Of course, when you are excessive risk, your cost of capital will be high because cost of capital measures your risk. Higher your risk, higher will be your cost of capital. The board of directors feared that several good projects has been rejected over the previous 2 years because they did not meet the company's high cost of capital threshold. Every company has certain threshold that above that they will not accept a project. Let's say your threshold is 10%. Above 10% cost of capital, whatever the project is, you will not accept. So each director put forward a proposal which they discussed internally. At the conclusion of the dinner, the director decided to ask for a written report on the proposals put forward by the first and the second director before taking all the three proposals to the board of directors for further discussion. Coming to the first director's proposal. So now, for writing our report, we need to read the first and the second director's proposal only. Third director's proposal, we'll leave it when we are reading for part C because we don't need for report writing, so we are not reading it. This is called time saving, and also you should know exactly what you have to read and then answer. But Even alternatively, you can even read all the three directors' proposal and read the whole case study, and then also you can sit to answer the case study. So first director's proposal is what? The first director is of opinion that the company should reduce its debt. Reduce its debt in order to mitigate its risk and therefore reduce cost of capital. So their policy is to reduce debt because it will reduce what? Risk and also cost of capital. Okay. He proposed, what type of risk is that? Debt means financial risk will reduce. So when risk reduces, definitely cost of capital will reduce. So he proposes that the company should sell its repair and maintenance service business units. Sell. Sell is the word. Repair and maintenance services business units and focus just on offering bespoke travel services. Okay, so only he will be left with travel services and hotel accommodation. Maintenance services is selling. So in the sale, the book value of non-current assets will reduce by 30%. Book value of non-current assets reduced by 30% and book value of current liabilities, okay, will reduce by 10%. It is thought that the non-current assets can be sold for an after-tax profit of 15%. This is your return. Okay, so the first director suggests that the funds arising from the sale of repair and maintenance services, business units and cash resources should be used to pay off the 80% of long-term debt. Now, when you go to your balance sheet or your financial position, you will see that there's a long-term debt. Out of that, 80% will be paid. How? From the you are going to sell your repair. So from that, whatever the fund you are receiving, and also the cash resources which the Morada company currently has, they are going to use that to pay off the 80% of the long-term debt. Because your ultimate goal is to reduce debt, long-term liability. For you to reduce it, okay, you're selling one department using the cash which you currently have in hand and paying the long-term debt. So sale of repair, cash resource used to pay 80% long-term debt. It is estimated that as a result of this, their credit rating will improve. Because when the company becomes less risky, their credit rating will improve. Okay. So now you haven't read the whole case study, but when you're practicing, you have practiced many questions. Of course, you have practiced many questions in credit rating improvement, when credit rating deteriorates, what happened to the value of the bond and all those things. So looking at this point, you know what you have to do. You're supposed to calculate something of bond with the different credit ratings, the market value of bond and something, right? Something like this. Second director's proposal. The second director is of opinion that risk diversification is the best way to reduce their risk and therefore risk. So every director, if you're seeing, they are concerned about reducing risk and therefore cost of capital. But the way of reducing is different. First proposal reduce debt. Second, it is risk diversification. Risk diversification. Okay. So he proposes that the company raises additional fund using debt finance. He's saying to raise additional funds using debt finance and then create a new strategic business unit. This business unit will focus on construction of new commercial products. Okay. Raise additional fund using what? Debt finance. This is his view. Okay. The second director suggests that $70 million should be borrowed and used to invest in purchasing non-current assets for the construction business unit. Okay. But one thing, when you're reading, each line have to be very clear to you. When you're reading it for the first time, because there is no second time. You cannot just keep. The main thing is not for you to finish reading in that time allocated. The main important goal have to be for you to understand the scenario very well. Properly everything you are picturized, you are imagining actually. Images are coming into your mind. That should be the goal, ultimate goal. The moment images comes in your mind, okay. Second director, you are thinking of a director sitting in his office saying this. risk diversification. Debt is increasing. See, the debt is increasing. And what is the impact? Where they are going to use that debt. So you have to be able to think like this. It's not just for the sake of reading or reading and then trying to answer. It will not work unless we are able to visualize. This technique is I have always used, which I want to tell you also. Visualize. I used to visualize things when I read. It's like a story you are reading. You have to read it like a story. You cannot just read for the sake of reading it and think that, oh, it's very boring. All this facts and information, so many things. This is this, this is that. You will get bored if you get bored, if you get demotivated. Reading it, how are you going to answer it? You have to have a whole from top to bottom. You have to understand the whole case study, summarize everything, and then that broad picture. So now I know by reading. First director wants to all the director want to reduce risk and cost of capital, but the way is different. First one was reducing debt. Second is raising debt to invest in non-current assets. So this is what am I doing? I'm summarizing everything. Now I have read everything. So you should have this power of summarizing the main thing, everything. That shows that how well you have understood the case study. When you're practicing, also see, talk to yourself. Of course, you must be talking to yourself. How much you have understood. You don't have to shout and tell it to someone else. Okay, that this is that and all. So the second director suggests 70 million. It will be borrowed and used to invest where? Invest in non-current assets. The new debt will be issued in a form of 4-year redeemable bonds. See, you have to be you have to know the calculations of this difference between irredeemable and redeemable bonds. The way calculation differs a lot. Okay, if you ask me what will come, I cannot tell irredeemable will come more than redeemable. There is no such thing. You have to know both. You in fact have to know everything, even the preference share, ordinary share, the way it is valued, the way a debt is valued, all the type of debts you have to know. Whether it is convertible bond, whether it is redeemable bond, whether it is irredeemable bond. Same for equity, ordinary shares, your equity shares, your preference shares, everything you should know how to value. It is there in the textbook only. But out of whatever you have learned, only one or two things will come. But bond is, yes, definitely bond is the one which is tested. So that you cannot skip. Preference share, maybe they will not ask. Equity, yes. Bond, yes. But equity is comparatively much easier compared to bond. Bond calculations are a lot of steps. So the new debt will be issued in a form of what? 4-year redeemable bond. Annual coupon. It is estimated that if this amount of debt is raised, then Morada's credit rating will worse. You see, because you are increasing the debt, talk to yourself like this. The way I am talking to you, you talk to yourself in your mind. That okay, what happens when this happens? What happens? Be curious. Be that curious type of student who wants to know what's happening, what's going up, what's going down. This thing comes in this flow is there in you. Trust me, any question, you will never be scared of answering any question. You'll be very confident because you can actually visualize the impact, what's happening up and down. So the next line I didn't read also. I just saw the credit rating. After that, I know what happened to the credit rating. Of course, it will go worse. Why? If you increase your debt, your risk will increase, financial risk. So credit rating will go down from this to this. So here it's a 50 marks question. Now you see how much they're testing you. First one, credit rating was improving. Second, credit rating is going down. You see. Now, current liabilities are estimated to increase to 28 million. Of course, current liabilities will increase. Think like this. Why? Because debt is increasing. Debt is increasing means what? Interest, you have to pay interest. So interest comes where? Current liabilities. You see? Everything is linked, one line. If you know that link, how one line leads to the next line and the next sentence, you will understand. There is no doubt of being having a doubt or something. Why this increase? Why this decrease? So the third director's proposal. Okay, we'll read it since it's very small paragraph and it's not a See, you always have to make a judgment. What do you have to read and what do you have to skip reading at that time? At this time, looking at third director's proposal, if this one was a lengthy paragraph, I would have skipped. Without wasting time, I would have answered. But now, since I see that it's not calculation, it's just some theory part, so I can, and it's small also, right? It is manageable looking at it, just 5 6 lines, so I can read it. So that's your judgment. Maybe you will not skip it, it's fine. Every person has different judgment. So the third director is of opinion that they does not need to undertake the proposal suggested by first and second just to reduce the company's risk profile. They are saying no need to reduce, undertake those proposals to reduce the risk. That is their third director's opinion. So she feels that the above proposals require a fundamental change in corporate strategy. What does she feel? Requires a fundamental change in corporate strategy and should be considered in terms of more than just tools to manage risk. Yes. Instead, she proposes that a risk management system should be set up to appraise the current risk profile. So he's saying risk management system to appraise their current risk profile, considering each type of business risk and financial risk within the company. Okay. So they have to consider each type of business within the company and taking appropriate action to manage the risk where it is deemed necessary. Even though you see that your first requirement, part A, was about business risk and financial risk. And here, in the last, they are writing business. It does not have so much of impact. The first part A, you can even write reading this paragraph also. Because it is just a definition. You just have nothing is there about business risk or financial risk specifically. Okay. Now coming to this. Financial position you don't have to read. Okay. That while doing calculations only you will pick up the number from there. Other financial information. Okay, so they're focused after tax earnings. You have to show impact of after tax earnings and on the statement of financial position. That's why they have given you the after tax earnings. So after tax earnings will be how much? This it is estimated that the company will make a 9% return after tax on any new investment in non-current assets. Of course, you are making. Are you making? You are making in proposal two for proposal for directors too. In that you are making an investment in non-current asset. For that the return is 9%. It is after tax, so you don't have to adjust for tax. Okay, and will suffer a 9% decrease in after tax earnings on any reduction in investment in non-current assets. Okay, so suffer a 9% decrease after tax earnings, reduction in investment in non-current assets, reduction. Coming to this, you will be given the share price, you'll be given all the information about debt, equity, beta, asset, beta, everything. So this paragraph is for that other information. By now you know what type of information you can expect. You don't even have to read it also. This is what I call experience. You must have practiced, I don't know how many questions, 30 40 questions. If you have done the whole revision kit, let's say you have done 57 8 questions. When you're going to the exam hall, I'm telling you, and this question comes, automatically your mind knows, your subconscious mind, it is there. You don't have to think what it is there, what could be there. You know, asset beta, something relating to asset beta, equity beta. Then for you to find the market value of your share, equity, market value of debt, and also the rate for the A2, whatever the what is the basis point, all those things will be there, and also the tax rate, the risk premium, the risk free rate, all those things will be here in other financial information. Because now you're experienced enough, you have done many questions, you know under the financial information what could come, so your mind automatically picks up. This saves a lot of time. That's why every student is recommended to do questions, past papers. Why? Because when you give to the exam hall, it does not come as a shock to you. You should not be wondering where a certain piece of information is. You should exactly know, okay, this piece of information, it is in the first line, or this is in the last paragraph. The moment you are able to picturize it, you can quickly go and locate the information when you are searching for some numbers or something, for when you are answering your requirement. This is time management. Imagine, okay, in the exam you just have 150 marks question and 225 marks question, but even just to score well in that 150 marks question, how many questions you had to do, right, when you are practicing. The more practice, the more questions from different questions. It's not just you have to sit with one question only 5 6 times you are doing one question only. It does not serve the purpose. You have to see the range of questions. What are the types of different questions can come, and see, mark somewhere or write that this type of question came in 2016. Again, it came in 2017. Similar type of question. Mark it somewhere. Then you will know where you need to focus more on. What question definitely will come, and what question is okay. I can, but you should not be lazy to touch each part of the syllabus. That is my whole point. That is the idea which I want to give. So now let's read the current share price. The current share price is this, and according to the company's finance division, it is very difficult to predict how the share price will react to either the proposal made by the first or the second. So they don't know how it will change. It's difficult. So therefore, it has been assumed that the share price will not change following the either proposal. Very important, your assumption. You have to state your assumptions, right? This is not a very good assumption, because share price do change if you increase debt or reduce it. But here, because it is difficult to predict for the finance division, they are saying it is same. For either proposal means what? First and second both. Okay. Finance division has further assumed. So all these are assumption. Even your assumptions will be here. Okay. Proportion of book value of non-current asset invested in each business unit will give a fair representation of the size of each business unit within Morada. Okay. So book value, proportion of book value of non-current asset invested in each business unit gives a fair representation of the size of each business unit within this one. Because we are given the book value of non-current asset, but we have two business units. We have to allocate between both of them. What is for the repairing and what is for the travel? Because we are selling one, right? Then the company's equity beta is this. While the asset beta of the repair and maintenance service business unit is estimated. See, asset beta of what? Repairs and maintenance, not the travel, the one which you are selling. You want to know the total asset beta. So the relevant equity beta for the new larger company, including the construction unit, relevant to the second director's proposal, has been estimated at this one. With the construction unit, the new equity beta, it is 1.21. Now, bonds are redeemable for 4 years time at face value. For the purpose of estimating the cost of capital, it can be assumed that the debt beta is 0. Yes. However, the 4-year credit spread over the risk-free rate is 60 basis points for A2 rated one. So it is 60 basis point for A2 rated bond over the risk-free rate. Over the risk-free rate means you have to add 60 basis point with the risk-free rate for A2 rated bond. If it is BA2, it is 90 basis point and 240 basis point for C3. Can you see that basis point is increasing? For A2 it is the least, but for CA3 it is the highest, because it is going worse. The worse it goes, the rate will increase. So your cost of capital will increase. Okay, your debt, cost of debt. Now tax rate is 20%. And the current risk-free rate. So risk-free rate is 3 and the risk premium is 7%. Okay. Now first part A. So my point here, let's start with the report today. I'm not going to start with section A. Section A and C, we'll do it at the end, because it can be done in any order. So we'll focus on section B first. We'll start making the report. For report, first point is cost of equity and cost of capital for first and second, before and after implementing. Okay, based on the market value of equity index. So many things we have to calculate. Cost of capital, cost of equity, market value of equity, market value of debt, both for first director's proposal and second director's proposal and before that proposal. Okay, it is always better to start with before, then you start with after. Okay, even when you present also, you have to do your presentation like that, before the changes and then after the changes. Presentation counts a lot, it matters a lot. So let's start with the report. One thing which I want to tell, let us first go through this and see. Okay, no need to read the whole thing we'll cover, but just see part BI. The first part of B was the hardest part of this question, the one which we are going to do just now. It was here to keep your nerve and to score the easier marks, right? Focus on getting the easier marks. If you're not getting something, don't waste time there. You know you will not anyway get it. If you waste more time also, you are not going to get around it. So don't waste time. Go for easier marks. There will be some easier marks. What are those easier marks? Let's see. They are for calculating the current cost of equity and cost of capital. That you should be able to do because without the change. And 6 marks are available for the 6 marks. And the key points in calculate the revised cost of capital. This will go through later. Okay. Go under easy marks. Part of this question is extremely challenging because it is important to target the easier areas and not to worry about getting every aspect of the calculation correct. This is unlikely to be achievable under exam condition, please. This is why I wanted to show you here. Most of you still knowing this, you try to be perfect. You try to perfect each and every question, each and every calculation. It is not possible, my dear friends. It is not. You cannot achieve it. If you try to go for perfection, you will lose time doing other questions. You cannot do it. Your aim should not be perfect. Your aim is to cover in that time, to cover the whole paper. 3 or 15 minutes, you have to finish the whole paper. So you have to keep moving. Okay. So the discussion part of this question, like part A, the third part of B and C, they are worth half of the marks. Including the professional marks in B, you will get marks. Therefore, even if you haven't completed your report, still you will get the full professional marks if you wrote your conclusion, introduction, the format is, the layout is correct, you wrote all the calculations or appendixes, you will get the full mark. Even if you haven't calculated or wrote all the important points in report. So try to get that professional marks. Okay, because this discussion part is half of the marks of the total 50 marks. Now, in part B, the third part, we have to state assumptions. The easiest marks are for stating your assumptions. You see, once when I was doing question 1 of 2019, June 2019 was my paper. I had to make some, it was a net present value and options I had, real options, option 2, abundant or something like that. I was not able to finish the report, wrote every value and all in my report, but I was seeing my time is running. But still I had some time, so I state my assumptions. After stating my assumptions, whatever calculations I have done, with that only I wrote my conclusion. I know it's not correct. I could have changed, but I didn't because I didn't have time. Time will go if I have to change the whole thing. And then I will not have, then I already saw what is there in question 2 and 3. 2 was exchange rate risk management, interest rate risk management, which I cannot afford to lose. I know that I can do very well in that. Next is reconstruction. Maybe not that well, but still I will manage to do it. So you have to be very sharp, you have to be very focused, and you cannot delay by 1 minute also. You have to stick to that time. Okay, it is the hardest thing in ACCA is to sticking to the time allocated to you. It is the hardest thing. I know it is not very easy for you to let go when you know for sure you have made a mistake or you haven't completed something, but you have to do it. If you are able to do the hardest thing, if you are able to hold yourself and proceed, you are getting yourselves more mark than what you are going to lose there. Trust me on this. So now, and also it was requested in the questions and it is worth up to 3 marks. So key assumptions include the assumption that the value of equity, see these are some key assumptions, okay? The value of equity is unaffected by each proposal, which seems high unlikely. It is unlikely, so that is one of the assumptions. Such that weightings used to calculate the asset beta in proposal to are accurate. That is also an assumption. And then any increase in earnings affects where retained profit. All these are what? Assumptions. Okay. So for the revised cost of capital, we'll come to this point after we do our this thing. But first two things we can read. Okay, read the question carefully. This told you to assume that the value of equity is unchanged under any proposal. And being aware of the information provided on movements in assets and liabilities was mainly relevant to second part of B. What's happening to assets, what's happening to liability, because you have to make a statement of financial position, the impact and all you have to show. So you have to show what is happening with assets and liabilities going up and down. Okay. So this point will come to this point after we finish. You must have read it by now, but we'll come again. Okay, for better explanation. Marcus Kim will see later. Part A if you say. Right? So part B. Now, report to Board of Directors, Morada. Fine. Then the introduction. This has to be there. Compulsory. You cannot just starting with your calculation and saying, okay, what you are going to do in the report. So this report provides a discussion of the estimates of cost of equity, cost of capital, impact of financial position, earnings after tax, as well as proposals put forward by the first and the second director. First and second director only. You see, very brief to the point. Only 3 lines. The main assumptions and also what are the assumptions. So the main assumptions made in drawing up the estimates will also be explained. The report concludes what the report starts with, what the report concludes with. Mainly this thing you are writing. It concludes by recommending which of the two directors' proposals, if any, should be adopted. 5 lines, that's it. You see, short and to the point. Work on your introduction also, improve on that. How you're writing introduction matters a lot, and also your conclusion. And the middle part, of course, you will do it. Coming to the discussion. This discussion part you will not be able to do. You need appendix, so we'll go to the appendix. If you see here, 1 and 2. Then the assumptions. You see how the report is in each paragraph. Discussion. So discussion is the first paragraph. First is introduction, then is discussion, then is assumption, then is recommendation. After that, your appendix starts. And if you see, the smallest part is your introduction and recommendation. Now, date. The report compiled by date. First, we are going to estimate the cost of equity and cost of capital. Okay. So before the either proposal is implemented, it is easy. Why? Because I know my equity beta. What was my equity beta? It was 1.2 into risk premium plus the risk-free rate. This. Then comes cost of debt. Cost of debt was 3.8% plus 0.9. Okay, we'll see 1.2 this. Okay. Since you must have forgot. So if you see here, okay, 3.8. 7 is the risk premium, 3.8 is risk-free rate. And coming to the equity beta, this 1.2 equity beta, we are taking this equity beta before. And then for debt, what are we taking? Risk-free rate. What is the risk-free rate? 3.8. What is my debt? What is the current rating? It is BAA2. Where is it? BAA2, it is a 90 basis point. How do you know it is BAA2? The current rating. Just go to 1. It is estimated that as a result of this, Morada's credit rating will improve from BAA2 to AA2 to A2. What does it mean? That they are currently in BAA2. Okay, so you have to add 90 basis point. Because from this, they will increase to A2 and they will fall to CA3 under the two proposals. So before that, it is BA2, which is 90 basis point. So you are adding 0.9 with the risk-free rate, and this is your cost of debt. Okay, these are easy. You should be able to do in one line. Then comes your market value of equity and market value of debt. So market value of equity is what? The share price was 2.88 into 125 million shares. This share you are going to go from your balance sheet. So now I know, I have done many questions on this. I know where to find the number of shares. Straightly you have to jump to your this thing. It is 40. So 50 divided by 0.4 is how much? 125. Okay. And the share price if I'm taking. So each information is taken from different places. Okay. But you have to be at a very high speed to take information and grasp it and write it very fast, because each information is not in the same place. You will not get all the information. You have to take from different places. Something will be in the first, something will be at the last, some from balance sheet, some from income statement. Like in this case, number of shares you got. What about the share price? Share price you have to take from here, this line. This is the importance of underlining. Once you underlined, your brain works that you have read this somewhere. So you exactly will be able to go back and see. Or highlight. Take a highlighter. I would recommend take a highlighter. Different highlighter if you want. But take it with you. Please. Now, you got. Now coming to market value of debt. Write it. If it's MBE and MD. Okay. What is the coupon? Coupon was. Okay. How are you going to get this? What is my cost of debt? Here you have to use your brain. That's why market value of equity I calculated, because it is easy, but market value of debt is not easy. You need your cost of debt. You need cost of debt to find market value of debt. Why? This one, look at this. 4.7% only. That is my cost of debt. That's why 4.7 to the minus 1 for the first year, second year 2. It is for the 4 year. So first year minus 1, second year minus 2, third year minus 3, fourth year minus 4. Okay. And coming to the 6.2. Look at the coupon. The coupon is 6.2%. Okay. That's 6.2%. So you have to take 6.2. That is the reason you are taking here. 6.2, 6.2, 6.2, third year 100 plus 6.2, 106.2 equals to this. Now what is the total market value of debt? This is market value of debt per 100. But the total market value will be this one divided by 100 always. Whatever the value you get, that divide by 100 into what? 120 million. This 120 million you are getting from balance sheet. Okay, here. This 120. It is 120,000, but it is don't forget the 3 zeros. 120 million. Okay. So it is 120 million. A million and not writing the M makes a lot of difference. You have to add this with your market value of equity and everything changes. So don't make this tiny mistakes. Now, cost of capital, you have all the things, whatever you need to find your cost of capital is there. Check before proceeding to cost of capital. Cost of equity is there, it is there. Cost of debt is there, it is there. Market value of equity is there, it is there. Market value of debt is there, it is there. Now what else is there? Just to put the figure and find cost of capital. So cost of equity into market value of equity plus cost of debt into tax is 20%, so after tax it will be 0.8 into the market value of debt divide by cost of equity plus market value of equity plus market value of debt. 360 plus 126.4, which is 10%. If it is 9 point something, also round up to 10%, round up to a whole number. Cost of capital. Now what happens if the first director's proposal is implemented? Go in order. Okay, first director, second director. So now you are told that cost of equity will not change. So market value of equity will not change. So equity will remain same because share price you cannot predict. So it will be 360 only. Book value of debt is not same as market value of debt. Okay, you have been told that book value will reduce because of the first director's proposal. Okay, we'll see. We know in the book value it is 120,000. Just now we calculated, but how much it will reduce? Go under the first director proposal. We have been told that non-current liabilities will reduce by the book value of sorry, this is current liabilities. Okay, you have to reduce your debt. Okay, so 80% of long-term debt will be paid off. That means you are left with only 20% debt out of 120,000. Okay, this 120,000, this 120,000 here, I have circled it also. Out of that, only 20% will remain. 80% you are paying off. Okay. So when I am going here, okay, 120, that's why I'm taking into 20%. Book value of debt. Book value of debt and market value of debt, please, unless they state it is same, you should not assume it is same. Here they didn't state that the book value and market value is same. It is different. That means it is different. You have to do calculations. You have to find the market value of debt. This is the mistake most of you have done here. You have taken that 24 million as the market value of debt and found everything. Cost of capital, which is wrong. But you have to find the, then you are asking why you have to find the book value of debt. If we have to find the market value of debt only. There's a reason why you have to find the book value of debt. You need that book value of debt to find the market value of debt. Without that, you cannot find. Every step is connected or linked to the next step. I told you. No, nothing is. You cannot say anything is anything what you have done is waste of time or not important. Cost of debt is 4.4%. Just check before it was 4.7%. Now it is 4.4%. It will reduce. Why? 60 basis point. So it is cost risk-free rate is 3. Now A, it improved, right? Debt reduced, so 60 basis point. That's why it is 4.4. Now, market value of debt. Coupon rate will be 6. This time this thing will change. The rate changed. Cost of debt changed. That's why you again have to find the market value of debt. It is the same way only. This time you are only left with 24. Multiply that with 24. So this is your market value of debt. Asset beta, you have to find the asset beta also. That's another extra step which was not there before, because before you are given already asset beta. Here you have to find the asset beta. What was your equity beta? From here you can see it was 1.2. So equity beta into equity will remain same, market value of equity plus debt into after tax. So this is your asset beta. Check asset beta. It has to be less than 1.2. Okay. This is equity. This is asset. Now, to calculate the asset beta of travel services, what do you need to find? Travel services asset beta. Why? You are retaining that only. You are selling the other one, right? But you are not given the travel services. Here, indirectly, you have to find out. Through a long way, you have to come because you are given for the one which you are selling off, the repair and maintenance services, asset beta. So to calculate the asset beta, now write this step. Wherever you are not able to calculate, wherever you cannot use a fixed formula, like for market value of debt and equity, okay, you don't have to explain that you're doing this. It is explained, understood. But this is, you have to explain. You have to write in words. Okay. So to calculate the asset beta of travel services, it will be assumed, state your assumption wherever it is, that it represents 70% of the value of the company. How are you saying it represents 70% of the value of the company? It is not clear cut. They didn't tell anywhere that this one is 70%, that one is 30%. Usually they say, there are some questions where they say, some they will not tell. You have to say. But the question also says that the percentage of the total book value of the non-current assets can be used to represent the total size of each division, and says that 30% of the non-current assets belong to the repairs and maintenance division based on non-current assets they are saying. Okay. We'll go and check that light. Okay. I know most of you are now thinking, where is this thing written? So before you people are confused, we'll do it and see. Here, this division. The finance division has further assumed the proportion of book value of non-current assets invested in new business unit will give a fair representation of the size of business. See, size of each business unit. They haven't given you the size, but they have given you a way to find the size. Now we'll go to non-current assets and see 280,000 non-current assets. Okay. So out of this 280,000, how are you going to find out? Here, go under the first director's proposal and see the book value of non-current assets will reduce by 30%. In the sale will reduce by 30% means what? 30% you are selling. What are you selling? Repair and maintenance. So repair and maintenance is 30%. The balance what is retained 70% belongs to whom? Travel. You see. So 70% you are selling of 30%. That means 30% is for the maintenance and 70% remaining is for travel. This is how you find out when something is not given directly to you. You have to know how to find indirectly also, like this. You have to link from this to that sentence. Because the two sentences are different. So you are retaining only 70%. Okay, so 30% non-current assets belong to repairs and maintenance. You just cannot put any number. Somewhere something will be there. Some hint, some piece of information is there for you to decide that. What is the percentage? This means that the asset beta of travel into 0.7 because 70% is for the travel, plus the asset beta of repair into 0.3. This is the proportion of repair and maintenance is 0.94. Why? Because this is the total asset beta we just now found. And the asset beta we found out was the total asset beta, including both repairs and travel. Now we have to separate the asset beta separately. So we are told that the asset beta of the repair and maintenance is 0.65 in the question. We have been told. The asset beta of repair we are given. We need to find the travel. So beta of travel into 0.7 plus asset beta into 30% for repairs is 0.94. Now, what is next? Next, you'll be able to find the remaining, the balance, right? Just make that the subject of the equation and find out. You shall be able to find the asset beta of travel, which is 1.06. 1.06 is the asset beta of travel. Okay. Next. Can we use this asset beta only for travel? Or we have to adjust it? Exactly. It needs to be re-get to calculate the equity beta of travel services. You cannot use asset beta and put in cost of capital. Oh, sorry, CAPM model. Most of you have done this mistake also. Asset beta you are putting in the CAPM formula and finding cost of equity. Wrong. It is equity beta. Who will find the equity beta? From asset beta you have to find the equity beta. You can find the equity beta. You know the proportion of market value of equity and debt. So asset beta into equity, market value of equity plus market value of debt. The new market value of debt into 80 because after tax divided by market value of equity, which is 1.12. It has to be more. It has to be more than the asset beta. Equity beta. Now this equity beta goes to the CAPM formula. 7% risk premium, risk-free rate 11.6. Can you see the cost of capital? Before it was 10%. Now it increased to 11.6%. So the cost of capital will be what? Cost of equity into market value of equity plus cost of debt into after tax into market value of debt divided by total market value of equity plus market value of debt. 11.1%. It increased. Okay. Cost of equity was before 12.2. It reduced, but cost of capital increased. Now second director's proposal is implemented. Market value of equity will be same only under all the three. All the two. but the basis point will be higher. They have told that your date will go down, it will worse. So at this 24 for 240 basis point. So risk-free rate is what? 3.8% plus 0.24, which is giving you, sorry, plus 2.4, now 0.24, 240. So it is 6.2. Cost of debt increased. Because of that cost of debt increase, you have to find the market value of debt. But before that, they are saying market value of debt is equals to book value of debt, which is 190 million. How are they saying that? 190 million. From where are they getting 190 million? And also they are saying book value or market value of debt is equal. For that you have to go to director 2, proposal 2. Okay. So here. Wait a minute. I kind of forgot the value for the it is 190 million. That is the debt. Okay. Will this live for a time? Okay. And we'll go to the I will be coming to that. Equity beta of new larger company is 1.21. It is given as 1.21. So that only will use in the CAPM and get 12.3%, and that you shall be able to get the cost of capital. Okay. Now the cost of debt is this into this into this, and this is 9.8. It reduced. Okay. 1.21 will go to that. Okay. Here this 1.21. Okay. They have told that with this construction unit the equity beta, so you don't have to find, don't try to go and find the equity beta with construction and all. You will not be able to find because you need asset beta for that. So it is already given to you, so you can find out. Now second one, debt will increase. If you see in your financial position is 120. Okay. And when you go to your second one, second director, this thing they have told that the second director suggests that 70 million should be borrowed and used to invest in non-current assets. So this you have to increase it by 70 million, from 100 to 20 by 70. That's why it is 190. Okay. So that's why if you see here it is 190. But one thing I want to find out is market value and book value. Have they given it somewhere? Why it is same? Let me go and see and read their notes. Oh, this is part C. I have to go to the report and see, maybe they have written it somewhere. So here they haven't told anywhere, but we'll go to proposal 2 and see. Okay, so there is no this thing, but this you have to be a little this thing. This is a little tricky why that book value and market value is same. So read this sentence for first director's proposal. When you are saying that 80% long-term debt will be paid, it is estimated that as a result of this, their credit rating will improve. As a result of what? As a result of paying that long-term debt, their credit rating will improve. Okay, so because of that, the market value will change. But coming to the second director's proposal, if you see, it is estimated that if this amount of debt is raised, then their credit rating will worse. Okay, from CA3 to BAA2, you just have to increase it by 70 million. The book value, okay, and the market value, it is the same only, because you just have to increase the debt by 70 million. That's it. Because in the first one, why the market value will change? Because you are paying the 80% debt, out of that 20% remains. So for that 20% bond which is remaining there, that market value will change. I don't know whether you are able to understand or catch me or not, but do comment me below if you got confused. See, 80% you are selling off, so out of that 20% remains, right? Of I think how much? 120, which is 24. Out of this 24, okay, the market value changes. Okay, this is the book value, but market value will change of the ratings. But in this case, it is just directly you are borrowing 70 million. So you are just increasing it by 70 million. Okay, so that's why the book value and the market value is same. Because you're investing that amount which you are raising in non-current assets. You're not having that debt anymore. You are borrowing that debt and you are investing in non-current assets. But in the first scenario, you're having the debt with you, not investing anywhere. That's why market value of debt changes. You have to change the market value of debt. But in the second one, you're taking borrowing, correct, but you are investing in non-current assets. That's why you don't have to find. That's why the book value and the market value is same. Because you don't have that debt anymore after taking it. You'll be investing. You're using it, utilizing it. So in that case, so there are some things which they have never told, but you have to understand. That's why this book value is equal to market. The market value is equal to book value, which is 190. Okay. Now coming to Appendix 2. Appendix 2 is estimates of focused after tax earnings and focused financial position. In this case, you have to draw that column and write everything. This is the current focus. So 3 column, current focused, first and second. Okay. This is the financial position down, and this one is after tax profit. First, we are starting with after tax profit. So after tax profits is what? 28,000 for all. After tax earnings, 28 million, because we are writing here, dropping down the 3 zeros. If you want, you can write it as millions also. We'll go to after tax earnings and see. Are we given anywhere after tax earnings and all? Yes, 28 million. They have focused after tax earnings for the company expected to be 28 million. Okay, so they have told it is 28 million. And then 9% return after tax on any investment in non-current assets, and suffer a 9% decrease in after tax earnings, reduction investment in non-current assets. Okay. So now, because in the first scenario, no change in the current focus, it will be 28 million only. Okay, if you say 28 million, only first and second proposal will change. Now we'll deal, when you have to deal like this, deal one proposal at a time. Don't try to do two things simultaneously. You will get confused. The rates are different. The scenario is different. So first proposal, I will write somewhere, debt increase. Because of debt increase, what happens? Your interest rate will increase. You have to pay more interest now. And also because of debt increase, tax will be saved. Tax payable, the tax will be saved, right? Tax deductible, interest is tax deductible. So first we are going to say interest, sorry, debt you have to reduce. I'm sorry. Debt you have to reduce, and here you have to increase the debt and invest in non-current assets. So debt will reduce. So interest saved due to lower borrowing. What is the interest if tax is, this is after tax. So tax is 20%, so after tax, cost of debt, the coupon rate, this is the coupon rate, 6.2%. Okay, the interest which you have to pay at this rate. And then 96 million. Why 96 million? Why it is 96 million? Because you are paying, what is the amount of debt you are paying? You're reducing debt means you're paying debt. You're paying debt means your interest will be saved now. You don't have to pay that much of tax. 80% you pay. 80% long-term debt. What was your bond? 120. 96. So you're paying off 96 means you're saving interest on that 96 million. That's why 96 million into 6.2%, that is the coupon, into 80 after tax. Coming to next. What is the reduction in earnings due to lower investment? There is lower investment in non-current assets, right? You are using it to pay off your debt. So you cannot invest in your non-current assets. So that reduction is 9% into 84 million. How do you get 84 million now? You are selling off your 30% of non-current assets, right? So we'll go to your non-current assets and see. If you go to 1, they are saying that 30% you are paying, right? 30% non-current assets will reduce. So your non-current asset is 280. So if you take 30% of 280, which is 84, so your non-current asset is reducing. You are suffering a loss of 9% on that. So 84. It will be in bracket because reduction. And coming to the last one, profit on sale of non-current assets. Since you are selling non-current assets, you are getting a profit, right? So you are selling at 84 and 15% as a profit. So what is this 15%? We'll see it. Yes, here. It is thought that the non-current assets can be sold for an after-tax profit of 15%. This 15%. You see? So that 15% only. And you are adding it. And finally you are getting it. So what is that increase from here to here? It is this. Now coming to proposal 2. Proposal 2, you are increasing your debt and investing in non-current assets. So for that increase in this, interest also will increase. Isn't your interest going to increase? Yes. How much interest will going to increase? How much you are going to increase? It's by 70 million. Coupon rate and after tax. So this. And then additional earnings due to higher investment. 9% only on 70. You add. And then this much it increased. Not from here to here. It is from 28,000 to this one. This is the increase. Write the increment amount also in front. Coming to the financial position. Financial position, the current forecast, just copy paste from your question. We are going to work on the first and the second. Okay. Now, if you're, let's say you're not putting this because it is already in the question, you're only putting this and this. You're not getting your full mark. You have to show your current forecast. It is very hard for you to compare otherwise. To look back every time and compare. It's a waste of time. I know it takes time to write all this and you think it's a waste of time. Why to copy paste simply again? But it is worth it actually. Everything in one place. Okay, so write it and then non-current asset. One by one will work. Individual, okay, individual items, one by one. First item and then we'll go for the second director. So the first director, non-current assets will change, current asset will change, share capital will remain the same, retained earnings will change, non-current liabilities will change, current liabilities will change. Okay, the non-current asset will change. First we are going to change the non-current asset. We are going to reduce the non-current asset. Okay, so out of 280,000 we are going to sell off 30%. That means we are remaining with 70%. Okay, so 70% of 280 is 196. Whereas in the second proposal it's going to increase by 70. So 280 plus 70 is 350. Okay, I'm going to show an arrow. Coming to current asset, if you say it's a balancing figure, so that you will be able to do it. Equity, share capital will not change, retained earnings will change, and if you see there are two star marks here, we'll see what is the note. With the two directors proposal, the retained earnings amount is adjusted to reflect the revised profit after tax earnings. Okay, it is reflected to adjust after tax earnings. What does it mean? It means that whatever this increase amount, you just have to increase it. Let's say for the first one 137, increase it by 9802. In the second one 137 plus 2828. Okay, then coming to the non-current liability. Non-current liability, 80% you are paying off, you only left with 20%, so 20% of 120. Next you are increasing it by 70, so increase it by 70, 190. Current liabilities. So current liabilities, we will work for first one. What is it? They told that the current liability will reduce by 10%. The book value of current liability. What is the book value of current liability will reduce by 10%. So we'll go and reduce it by 10%. What is it? 21,000. So reduce it by 2,100 because 10% of which is 18.9, and this one here it's increasing. How is it? We'll go and check for the second director's proposal. 70. Okay. So here if you see, the current liability is increased by 7,000. Okay. How did it do? How did it increase? You have to Go to the second. Your interest. Sorry for the delay, guys. Okay, but I'll read here. Now, okay. So you have borrowed 70 million, right? Current liabilities are estimated to increase to 20 million. Yes, this two, not by. So that's why it is 28 million. Okay, that means 28,000. So we are done with all the appendices. Now we just have to go and fill in the reports. So this table, the table below shows the revised figures of cost of equity and cost of capital, Appendix 1. And the focus earnings after tax for the coming year, Appendix 2, following each proposal for the first and second. For comparison purpose, figures before any changes are given as well. Now you are going to write all. Current position, first data, second data. Cost of equity, cost of capital, earnings after tax, using each appendix. Now, just see cost of equity, which is having the lowest. It is lowest in the first director, and cost of capital is the lowest in second director, and earnings after tax, it is highest in first director, right? So now you have to talk about each. First, you're talking about first director. Here, you're talking about second director. Under the first director's proposal, although the cost of equity falls due to the lower financial risk, why the cost of equity falls, you are giving a reason. For each, you have to give a reason. Because lower financial risk, your debt you are reducing, right? You're paying off 80% debt, so that's why cost of equity falls down in Morada because of less debt. The cost of capital actually increases. So cost of capital increases. This you have to write in words. This is because why every time something increase or decrease, I have told you always give reasons. This is because even though the cost of debt is increased, yes, the benefit of the tax shield is reduced. Tax shield is reduced. Interest you have to pay is becoming lower. So tax also you are saving is becoming lower. Significantly due to the lower amount of debt borrowing. Added to this, the higher business risk reflected by the asset beta of Morado. How do you know it has a higher business risk? Asset beta tells you. Asset beta measures business risk, equity beta measures both business and financial risk of Morada, just operating in the travel service. So just operating in the travel service sector. It has a higher business risk because of that. And you are retaining that one only. You are selling off the one which is having a lower asset beta, that means lower risk, the maintenance. That's why the cost of capital increases. So this higher business risk can reduce tax shield more than override the lower cost of debt, resulting in high cost of capital. So you are saying that the higher business risk and the reduced tax shield is more than the reduced cost of debt. That's why cost of capital increased. How beautifully they have answered. We'll go and check the asset beta. You want me to go and show you the asset beta? Okay, fine. We'll do that. This shall take a little time because I'm going up and down showing you, but it's okay. Cost of asset. Where is that cost of this part? So look at the cost of asset beta. For repair it is 0.65, but asset beta for the travel is 1.06. 1.06 is much higher. Okay. Second, under the second director's proposal, when you're writing about different director proposal, put it in different paragraph. It's much easier to understand. So under second director's proposal, or what's happening? Keep the number in front of you and then write. Cost of equity is almost unchanged. Almost unchanged means it is 11.1. Sorry. Wait. Cost of equity 12.3%. Yes. So 12.3% from the current position you have to compare. 12.2, 12.3, slight increase. So almost unchanged. There has been a significant increase in the cost of debt from 4.7 to 6.2%. Yes, we saw that. Cost of debt increase. Cost of debt. Even though you haven't written everything here, you only wrote cost of equity and cost of capital, but that does not mean that you cannot say about cost of debt. So don't keep this assumption that whatever you have written and summarized only, you have to write only about those numbers only. Other numbers you should not discuss. No, you can talk about asset beta, equity beta, cost of debt, all those things. If you see in the second proposal, what happened? It significantly increased. So you have to tell it's a significant increase. When it's not a significant increase like this, say it is almost unchanged or very minor and all. However, the cost of capital has not reduced significantly because the benefit of tax share is also almost eroded by the increase in cost of debt. It is eroded by the increase in cost of debt. You are taking higher debt now, so that tax shield is also eroded, and the cost of capital has not reduced significantly. Why? If you see the cost of capital, it was, what is it, 9.8. It didn't reduce. No. I think something is wrong here, because this is 9.8. It reduced. Okay, that reduction is not so much from 10%. Okay, that's what they meant. It is not very significant compared to that increase in cost of debt, because we know that debt increases means higher tax shield will be there, so cost of capital should have reduced more, but the reduction is less. That's what they meant. Okay. Now third one, you're comparing, talking about what? After tax. So if no changes are made, then the focus earnings after tax as a percentage of the non-current asset is 10%, because this is your after tax earnings, this is your non-current assets, this is just 10%. So how beautifully you are saying, first when what happens when no change, then under first, then under second. So under the first writer's proposal, this figure almost doubled to 19.3%. You see, you have to you are calculating what additional ratios. Did they ask anywhere? No. Have you done it in appendix? No. Even in the main report you can do such. You don't have to put this in the appendix. In the report itself you can write the ratios and all, you can calculate. It's always good, better, in fact. It increases your marks. So 37.8 divided by 196. Now you have non-current asset of this much. Check your balance sheet, and this is your 37.8. Your non-current assets. Sorry, after-tax earnings. Just check here. 37.802. So you're taking 37.8. You have rounded up. It's fine. It's almost, you are free to round up. And even if the one-off profit from the sale of non-current is excluded. Why one-off profit? It's a one-off profit, right? You don't always sell non-current asset. Only once you sell and that's it. So even if this one-off sale of non-current asset is excluded, this figure is still higher at 12.9%. Okay, 25.2. What was the profit from selling of non-current asset under proposal 1? It was 12.6. I suppose, yes, 12.6. So this is one-off profit. So if you exclude this also, right, 37.8 minus that 12.6, it is 25.2. Still the figure is higher than 10%, 12.9. So under the second director's proposal, this figure falls to 8%. How? This is your after tax earnings and this is your the non-current asset, which is not great. Now assumptions and then recommendation. So what is the assumption? It is there are three assumptions. Okay, it is assumed that the asset beta is a weighted average of the asset betas of travel and maintenance business units using non-current asset investing as a fair presentation of the size of each business unit, and therefore the proportion of businesses within the business unit within the company. Right? What did we use? 70 and 30%. Why? Based on non-current asset. We assume that it was a fair representation of the size. So this is one of the assumptions. Second, assumption of share price not changing after either the proposal is not reasonable. It is not reasonable. When something you feel very strongly which is not reasonable, state that it is not reasonable. Where you have a confusion, don't say it is not reasonable, but just say it might not be reasonable, unlikely to be reasonable, like that, where you are not very sure. In this case, it is very sure. It is not a reasonable this thing. It is likely that due to changes in business or financial from implementing either proposal, risk profile of company will change. Yes, the changes in risk profile will influence the cost of equity, which in turn will influence the share price. Right? Because we saw cost of equity changes. When cost of equity changes, definitely share price will change. Coming to the third one. In determining the financial position, it is assumed that the current assets will change due to changes in the profit after tax figure. Current assets will change due to changes in profit after tax earnings. Yes. Therefore, this is used as a balancing figure for each proposal. Now you see why it is balancing figure, because we are assuming that if there's a change in profit after tax, current assets will change. Okay. Now, before I go to recommendation, one more thing I want to go and show you here, which I forgot to mention about. It is not wrong. Here we didn't take the tax impact, right? The tax saved on the additional borrowing or something. What the reason is, already it is after tax. It is taken because this rate 9% is after tax. And here we have adjusted for tax. Okay. So that 9%, the two things is after tax. Now, we are in the recommendation. Finally, it is recommended that neither the first nor the second should be adopted. Neither. Sometimes it is neither, sometimes it is one, sometimes it is both could be adopted. In this case, it is neither. Why? Second debtor's proposal results in lower return on investment and virtually unchanged cost of capital. Right? From 12 point, cost of capital, we'll see. It is from 10 to 9.8. It is virtually unchanged for the second director, the cost of capital. And also lower return on investment for the second director. We just saw from the ratio 8.8% it fell down. So there will not be a meaningful benefit for Morada. The first debtor's proposal does increase the return on investment, yes, but results in a higher cost of capital. So if the reason for adopting either proposal is to reduce risk, what is your main goal? To reduce risk. Can you reduce risk in one of it? No. Then this is not achieved. So the main caveat here is that where the assumptions made in the calculations are not reasonable, they will reduce the usefulness of the analysis. Assumptions, you have to state this. If assumptions in the calculations are not reasonable, they will reduce the usefulness of the analysis. You have to state this. Have to. Must. Now we'll see the marking. Now we'll see this part. Only part B, because I will be explaining part A and part C in part 2 of this video, which will not be so long. The thing I'm taking it in a separate video as a separate part is I want to explain just work on the theory part. Okay, otherwise you'll be panicking that we have so much of things to calculate, do, and also now we have done with the main thing. The report. Appendix 1. Prior to implementation, cost of equity 1 mark, cost of debt 1 mark, market value of equity, market value of debt is 2 marks here. You have to do extra working. Cost of capital 1 mark. You see each step you have to be correct to get 1 more. Mark is less, but steps are so much. Market value of debt again is 2 marks. Asset beta, you have to calculate. Asset beta of travel services only you have to calculate. Equity beta of travel services only 1 mark. Cost of equity, cost of capital, 1 mark. After implementing market value of debt, again 2 marks. You are not getting any marks for market value of equity. You have to write it, but not getting marks because it is already there. Cost of equity and cost of capital. Coming to Appendix 2. Adjusted earnings. So 2 marks, 2 marks, and 2 marks. And 1 mark. For the adjusted and the financial, for the adjusted and the financial position. And coming to the discussion, 5 to 6 marks. Assumptions 2 to 3. And recent recommendation that neither will be accepted in this case. So now, and also report format 1 mark, structure and presentation 3 marks. Part C 1 to 2 marks and part A also 3 marks. I've told you, divided equally between business and financial, between risk mitigation and risk diversification. So that will be in part 2. Before I end this video, let's read this part. Remembering that the market value of debt is needed for a WACC calculation, and then this is not the same as the book value of debt. To work out the market value, you need to calculate the present. How are you going to get the market value? Present value of future cash flows and discount at the company's pre-tax cost of debt. That's what we did. We took 6.2%. We took the cost of debt pre-tax, before tax. Discounted. We found the present values, right? That's what we did. So that's it for this question, and don't forget to watch part 2 of this as well, which is coming soon. Thank you. Take care. God bless you.